In 1929, some of the smartest men on Wall Street lost everything in a single week. Not gamblers, not amateurs, professionals who understood the market better than almost anyone alive.
So what does that tell you about the real danger of investing? It isn't ignorance, it's confidence in the wrong thing.
One of those men watching the wreckage up close was a young Columbia University lecturer named Benjamin Graham. He hadn't just studied the crash from a distance, he'd lived through the losses himself, watching a market he thought he understood turn into something unrecognizable overnight. Instead of walking away from investing, he did something almost nobody else was doing. He stopped asking what will the market do next and started asking a completely different question. What is this actual business worth, regardless of what anyone feels about it today? That single shift in thinking became the foundation of a book that Warren Buffett would later call the best book on investing ever written. Not because it revealed a secret formula, but because it revealed something far more uncomfortable. The biggest threat to your money was never the market, it's you. To understand why, picture two very different characters Graham uses to explain the market's personality. Imagine you own a small piece of a private business alongside a partner named Mr. Market. Every single day, without fail, he shows up at your door and offers to either buy your share or sell you his, always naming a price. Some days he's euphoric, offering you triple what your share is worth. Other days he's terrified, offering to sell a share for a fraction of its value. Here's the catch. Mr. Market doesn't care whether you trade with him or not. He'll be back tomorrow with a brand new mood and a brand new price. Most investors treat Mr. Market's price as truth. Graham says that's the single most expensive mistake in investing. Mr. Market isn't rational, he's emotional. And the moment you start believing his mood swings reflect actual value, you've handed control of your financial future to something no more reliable than a stranger's temper. So if price isn't truth, what is? Graham draws a sharp, almost uncomfortable line between two words people use interchangeably: price and value. Price is what Mr. Market is shouting today. Value is what the business is actually worth, based on its earnings, its assets, its ability to generate real cash over real years. A house doesn't become more structurally sound because a buyer got excited and overpaid for it. And a company doesn't become more profitable because investors got euphoric and bid its stock up 40% in a month. Yet somehow in the stock market, people forget this basic truth constantly because a rising number on a screen feels like proof, even when it's just noise. This gap between price and value is where Graham introduces one of the most important ideas in the entire book: the margin of safety. Imagine an engineer building a bridge designed to hold 10,000 pounds. A reckless engineer builds it to hold exactly 10,000 pounds. A wise engineer builds it to hold 30,000. Because trucks get overloaded, materials wear down, and estimates are never perfect. Graham argued investors should think the same way. Never buy a business at a price that only works if everything goes right. Buy it at a price so far below its real value that even if you're wrong, even if the future disappoints you, you're still protected. Margin of safety isn't pessimism, it's respect for the fact that nobody, no matter how smart, can predict the future with certainty. So if predicting the market is unreliable, why do so many intelligent, successful people keep trying? Because of a trap Graham identified decades before behavioral psychology gave it a name. Humans don't naturally think in probabilities, we think in stories. A stock going up feels like a story of a smart decision. A stock going down feels like a story of a mistake. So investors chase the stocks already rising, convinced the story will continue, and abandon the ones already falling, convinced the story is over. But Graham's data told a different tale entirely. Some of the best returns came from unloved, overlooked, boring companies nobody wanted to talk about at dinner parties. The market doesn't reward excitement. It rewards patience applied to overlooked value. This is why Graham draws the defining line between two types of people who walk into the stock market believing they're doing the same thing. He calls one the investor and the other the speculator. The investor studies a business, calculates what it's actually worth, and buys only when the price offers protection against being wrong. The speculator buys because the price is moving and a feeling says it will keep moving. On any given day, both can make money. But over years, over decades, only one of them is operating on something more durable than luck. The investor's chief problem, and even his worst enemy, is likely to be himself. Not inflation, not a recession, not a corrupt CEO, himself. Because the numbers behind investing are simple enough for a teenager to learn in an afternoon. It's the psychology that destroys people. Watching your portfolio fall 20% and feeling the primal urge to sell exactly when the business becomes a better bargain than it was the week before. Watching your neighbor brag about a stock that tripled and feeling the urge to chase it exactly when the price has drifted furthest from its real value. To protect ordinary people from themselves, Graham didn't just offer philosophy. He offered a practical archetype, what he called the defensive investor. Someone who doesn't try to outsmart the market, doesn't chase headlines, doesn't attempt to time tops and bottoms. Instead, this investor builds a simple, diversified portfolio, invests consistently regardless of the market's mood, and rebalances occasionally with the same emotional temperature as someone checking the weather. It sounds almost too simple to work, and yet, decades of data since the book's publishing have shown that this boring approach has quietly outperformed the majority of professional fund managers who spend their entire careers trying to be clever. There's a strange irony hiding inside that fact. The people trying hardest to beat the market are often the ones most damaged by their own overconfidence, while the people humble enough to admit they can't predict the future end up protected from the very mistakes that sink the confident. Which brings the entire philosophy back to that image of Mr. Market, standing at your door every single day with a new offer. The wise investor doesn't ignore him completely. Sometimes his panic creates a genuine bargain worth buying, and sometimes his euphoria creates a genuine opportunity to sell. But the wise investor never lets Mr. Market's mood become their own. The market is not there to tell you what something is worth. It's there to serve you, or to be ignored, whichever protects you best on any given day. Graham wasn't trying to make anyone rich overnight. He was trying to make them safe for a lifetime. Because real wealth was never built by the person who predicted the next big move. It was built by the person disciplined enough to know what they didn't know, patient enough to wait for value instead of chasing excitement, and humble enough to protect themselves from their own emotions before the market ever got the chance to. The next time a number on a screen makes your heart race, remember, that number is just Mr. Market's mood today. Your future is built by the decisions you make when nobody else is paying attention. If this changed how you think about investing, subscribe to Proven Pages. Every documentary explores one timeless book whose ideas still shape the world today.